here's a question from a real estate investor, and this is actually a question that I get a lot from some of my clients who are investing in real estate. So let's look at the question. So let's assume that we close on a rental property before year's end. Are we still eligible to take the bonus depreciation in that year? And the answer is, as always, it depends. So the big thing that you need to look at whenever it comes to taking bonus depreciation on a rental property, number one, whenever you buy a rental property, in order to take bonus depreciation, a lot of times you have to do something like either a cost seg, or maybe if you kept track of the receipts of the different types of furniture that you purchased, or maybe different types of appliances or whatever, you can bonus depreciate those. But in order to do bonus depreciation on a rental property, you have to do first a cost segregation. That's essentially where you get an analysis done on your property and they extract out the 5, 7, and 15-year component in your property. Remember, your property is depreciated at either 27.5 years for residential or 39 years for commercial. Also, your short-term rental automatically defaults to 39-year property. And my short-term rental investors, don't forget that your short-term rental is actually depreciated at 39 years instead of 27.5, even though it may be in a residential neighborhood. It may be looked at as a residential property. Short-term rentals are actually 39-year property. Now, whenever it comes to being able to claim that bonus depreciation on your tax return, largely depends on if you place the property into service. Now, just because you buy the property near year's end doesn't necessarily mean that you qualify to take the deduction in that year. You actually have to place the property into service. And then also the last thing I want to talk about, since we're talking about bonus depreciation and cost segregation, is the passive activity loss limitation. Remember, whenever you do a strategy like this, you are going to create a large paper loss on your tax return. A lot of investors want to take that loss and use it against their income. However, your rental property is by default considered passive. So any losses that are generated from that rental activity will be considered passive and therefore cannot offset your W-2 or other non-passive income unless you have a modified adjusted gross income of $150,000 or less. Now, there are workarounds to this limitation, and that is where real estate professional status and your short-term rental loophole come into play. Again, I've talked about these strategies before and I will talk about them again, but if you have any questions, feel free to shoot us a DM and we can shoot you more information on real estate professional status and the advantage of investing in short-term rentals that you can actively manage.